Today's video. In this video, I'm going to teach you a strategy that you can help you to attain $50 each and every day if you follow all the rules that I would lay out. You are going to be using EMAs plus the Traders Dynamic Index for you to attain this objective. All right, so market makers control the game. Are you the player or you are the pawn? It's basically an iron to define which side are you in these particular markets. So the market we trade involves market makers. These are the people who are responsible for putting in the funds that push impulses. Whenever they get into the markets, we see the market reacting by moving very quickly in one particular direction. So these impulses result in what we call peak formations, which are basically reversal points. So these points of reversal are special to us, especially in this particular trading strategy. The summary of this video is to identify these points and trade away from them, and I'll teach you exactly how to do it. Without further ado, let's jump right in. All right, the first thing that we are going to talk about is the time frame of observation. Because time frames are important, they determine your stop loss as well as your targets. The higher the time frame, the more patience required to wait for these trades to mature, and most people do not have much patience. I can actually tell you who is on the other side of the screen, are you patient to wait for a trade that will move for weeks or months? Definitely not. So you need to focus on these two time frames, and they are used in this particular way. So the H4 time frame is used to determine a peak formation high or peak formation low. So you need to write it down. H4 time frame is going to be for peak formation location or peak identification point. Then M15 is used to get an entry. Why M15? It is a small time frame which will allow us to get a pristine point of entry as well as reduce the magnitude of our stop loss. So let's now get into the strategy. Strategy definition. We are going to talk a short background on the strategy, how it actually arises on our charts. Because when we are trading, we are trying to be people who finds things that occur frequently in the markets and keep on repeating on that same particular basis. So market makers have finite funds, therefore at some points within the cycles need to close off their positions. They are saying they can buy. After buying a particular asset, at some point they will need to close that particular asset. And whenever they close a position, the market respond with a drop of demand and is reflected on the charts as a price pullback. So in our strategy, we'll be stocking this behavior. What we want to see is basically that impulse, and then when they are pulling back, we want to add, or we want to get into the market as they are now adding in their positions. So we want to enter as the market makers enter again to continue with the cycle. So below are the conditions for buy and sell. At this particular point, you now need to pay much closer attention so that you can comprehend what I'm trying to put across here. All right, so here are the conditions of entry. We are going to go step by step so that you can actually be able to replicate it. Step one is to determine the peak formation using the H4 time frame. Following these steps, I'm sure that you are probably scared or you are freaked out. How do I identify a peak? I haven't done so, or I have been facing problems, or you have been it has been something that was difficult for you to do. So open the H4 chart, which is basically segmenting the price into weeks, right? Then step two, we are going to use the Traders Dynamic Index, which I talk more on this particular channel. I have several videos on the TDI, and on that TDI, what we want to see is the H4 shark fin. By H4 shark fin, it's basically a point whereby the RSI line on the TDI goes outside the bands like this, right? So we want to spot this shark fin, and market is shown below, right? So in this particular case, you can see these white boxes is what we want to see. For the benefit of those who do not know what a Traders Dynamic Index is, it's actually an indicator that shows market sentiment and volatility at the same time. So there are these blue blue bands, which we call volatility bands, derived from Bollinger Bands, and there's this green line, which is the RSI line. It actually measures the relative strength of the currency in their pairing. So what we want to see on H4 is basically a piercing out of the market like this, and then whenever the market pierces out, we now start to we term this particular point the peak. So this becomes a peak. It pierced out here, and this became our peak. It pierced out here, and this became our peak. So basically, this is the first step that you are going to do. Then the next steps are, after peak identification on H4, the next step is to switch to the M15 time frame. If you go to the M15 time frame, we are now getting ready to enter the market. On this part, what we want to see is a lock of the peak on the H4 time frame. Of course, the H4, you've seen a peak. You have actually marked the peak, but now on the M15 time frame, we will now want to see that peak lock, right? So how does a peak lock? A peak locks after a 50 EMA and a 200 EMA crosses, and then wait for the following, right? So after a 200 EMA and a 50 EMA have crossed, we can say the peak that we've identified on the H4 time frame has logged, and now we must now see the market makers closing off their positions, resulting in the market retracing or the market pulling back to the 200 EMA and retest, right? That is the next step. After retesting the 200 EMA, we need a candle closure below or above the 13 EMA as shown in the following examples. So peak lock, then pullback, retest. After that, we need to see a candle closure above or below the 13 EMA as what I am about to show you. All right, before we dive in the examples, check out my free Telegram channel. I'll leave the link in the description box below. It's actually a good community where I share trading advice, sometimes free signals, as well as setups. All right, so here's example one. And in this particular case, I have already marked the peak formations using the H4 time frame. So in this case, this is a peak formation high. We can see a peak lock as our first step after 50 in white, 50 in blue, and 200 in white have crossed here. And after that, we can see that this was an impulse and the market maker had to close off some positions. That is why we can see this pullback, and we can see step 2, M15 200 EMA retest, and then candle closure, which occurred here. Entry at candle closure below the 13. The 13 is the one in red. And then after that, we can see our plus 50 pips, which is going to give us $50 on this particular instance, was issued. The market actually dropped to this particular price point and we close off. Where is our stop loss going to be? Right above the structure, which allows you to have approximately 20 to 25 pips so that the risk to reward will be at least 2 to 1. That was example one. Example two, you can see Euro USD, we had this peak formation high, and after that peak formation high, we had this peak lock at this 200 EMA cross, and then the market went to the downside. From this point, we can see that there was this consolidation. It shows off that market makers are booking their entries, and we can see the market went back to the 200 M15 200 EMA retest was issued, and after that we can see that the market closed below the 13 EMA and plus 50 was actually attained. It's actually a $50 in your pocket. We are considering that you are trading a very small lot size like 0.1 on Euro USD. Then last but not least, GBP card example on M15 time frame. Peak was issued, then peak lock was actually issued here after 50 200 EMA cross. They had a very long impulse drop without pulling back to the 200 EMA, but later did so at this particular point. And this is a 200 EMA retest and entry below the 13 EMA, and with one candle, 50 pips was actually attained, basically like that. So discipline and consistency I have to emphasize on this particular part, because you may learn, you may actually go through and attain a very powerful trading strategy. But if you are not disciplined, you are not going to reach your destination. You will be a fool if you expect different results using the same method. The same method of overtrading, the same method of over-risking, the same method of adding to losers. If that is what you are doing and expect different results, always know that you are I'm not going to finish that one. So you have seen that without discipline, you are not going anywhere. Therefore, change your ways. This strategy is profitable over several trials, and you may remove the subjectivity and difficulty so that it becomes much more streamlined and you get more entries which are high accurate using the strategy taught in the Top 1% Traders course. You can be part of the Top 1% Traders course, be part of the students group or a students community where we only focus on discussing one strategy. On that note, we've come to the end of our today's video. Thank you for watching. Like and subscribe, and I'll see you in the next one.